Hello, good evening. Welcome back to Hurdle Rate. In this video, we are going to build a DCF model for Coinbase from scratch. So let's dive straight into it. First things we'll do is we'll just have a look at the price action from the last, I guess, and on this chart, it's the last couple of years. As we can see from the end of, from 2023 onwards, Coinbase seemed to have a steady rise going, hitting a peak of about 440. And now it's pulling back as the Bitcoin price has come down. It's broken through its 50-week moving average and looks like it could be heading towards the 200-week simple moving average. So it's not quite oversold yet on the weekly on the RSI, but it's it's come down quite a bit in the last the last few weeks, the last few months. If we just have a quick look at the Bitcoin price as they tend to move together, we can get a good idea of how this is doing. So yeah, 1 second, let's pull this up. Yeah, so the Bitcoin price on the weekly has broken through its 50-week moving average, and it looks like it could be heading towards I guess the first, I mean, if we're looking at it from a trading perspective, the first support is around the 74K level, and then yeah, the next would be where the 200 week simple moving average is. That would be, looks like it would probably be the bottom to hit there on the RSI. It's heading towards oversold 34. Once it goes under 30, we tend to see that as being in, well, below 30 sold. So yeah, let's dive straight into building the model. From the trading perspective, we don't want to worry about this because we're long-term investors. We're looking at a 3 to, I guess, 5 year time horizon. We don't want to worry about these fluctuations in the short term. So that's why we want to build the DCF to work to understand what the intrinsic value of the company is based on the forecasted cash flow that we think it's going to produce. So we need to come onto the SEC website, go for Coinbase. We need two 10Ks for this one. We need the one from 2024. So this one is 15th of the 2nd, 2024, and that's on page 6. Then come to page 2, I think it is, for the other 10K. Here it is, 13th of the 2nd, 2025. And on the first page, we'll find the latest. This one, 30th of the 10th, 2025. Open those up. Come to page 97 on the 2024 one. Page 93 on the one that was released in this year, the annual for the year ending, for the end of year 2024. This one is for the end of year 2023. So this is for 2024, then this is the 10Q. Come to page 14 on that one. Open up your Excel spreadsheet, go page layout, remove your grid lines, go view, freeze your first column, and where your A is, just insert another column. Make the A smaller, make the B larger, and in A1, just type coin. That's the Coinbase ticker. Then go data, stocks. And we're going to use Excel to pull up the things like the price, anything else that we might need. It's this one, Coinbase Global Stock NASDAQ Market Coin. Perfect. Okay. Zoom in a bit. So here, let's go ticker, date. We want to know the current price, the implied price, and there's any up or down side. We just do a bit of formatting. Over. And ticker, just go equals A1 dot, open your parentheses, ticker symbol. Coin, the date today is the 22nd of the 11th, 2025. Current price, we go equals A1 dot, open parentheses again, price. And these two we can leave because we don't know them yet. It's whatever the model tells us, basically. Let's enter this here. Just put an X in. Price. We'll use this. We usually use this navy blue color font. Go. And this one is going to be called assumption. We put revenue segment here. And if you haven't done this before, what we're going to do is we're going to list the different revenue segments, EBIT, WACC, terminal growth value, and we're going to be able to simulate through different scenarios. So using our switches, which I'll show you how to do when we come to it, we can simulate bear, base, and bullish scenarios to give us an idea of where the price could be relative to certain things happening. So the first one we're going to do, the great thing about Coinbase is it does break down all of each revenue segment into how it's what it's composed of. So transaction revenue, you can see that consumer significantly outweighs the institutional, but the institutional is growing quite a bit, and it should become a significant part of the business. I'm just going to go transaction revenue, subscription and services revenue, and the other revenue, just to save time. But if I would advise you to break it down into this more granular level of all of these here, so that you can simulate different. You'll be able to simulate different scenarios more accurately. So we go transaction revenue. Revenue subscription. And upper. Put a 2 in here. The next line we want is the EBIT, then WACC, terminal growth value. The WACC is the weighted average cost of capital. We'll get to that later on once we've built out the revenue and the DCF model. The WACC is the figure that we use to discount the forecasted cash flows back to the present value. We do that because of the time value of money. $1 today is worth more than $1 tomorrow because of the risks associated with it. It's there's inflation. There's that you might not get those. You might not get that. There's so many risks with that, which is why we discount it to a present value. So what do we want now? So revenue build. And we put this one equal to E10, which is transaction revenue. And let's start in 2021 this time, just because we have the figures here. We might as well take them. It up to 2030. Here we want growth. We want a bear, base, bull. Okay, we're good. Started. So come on to the first 10K, the oldest 10K. This is what we need. Wow, look at that. In 2021, obviously, there was the bull run, but 7 billion down to 2.5. That's a drop. So these are in thousands, but we're going to be doing this model in millions. So we put just format first. number, no decimal places, 1,000 separator, and it's for the negative numbers. So 2021, the company Coinbase did 6837.266, then 2356.244, 1519.54. To work out the growth, we just you take the year that we're in, divide it by the previous year, then minus 1. 4. 3986.113. 5. 9 months. So we can say let's go 3986 divided by 2430.147. That gives us our multiplier 1.64. Take this 3072.738 multiplied by 1.640279. Okay, so we anticipate that they'll do about 5 billion in revenue by the end of this year for transaction. So for next year, for 2026, let's take an average of the last 3 years. So 50%, and eventually we imagine that it will go to 15. I think it's possible. I don't mind saying it could go to 20. Let's try that. Then to work out these 3 here, let's say you go equals, you take the previous year minus, open your brackets, previous year minus your final year, close your brackets, divided by, open brackets, your final year minus the previous year, close brackets. And we want to just sort of be able to copy paste all of this. So we need to lock in a few things. So for here, this doesn't need to be, this doesn't need to be this one. We need to lock in the column, but not the row. For this cell, that will always be the same. So we lock in both the column and the row. And this one, we want it to move along the columns, but not the row. So we just lock in the row. Go column width, put it back to 10. All of this 2 decimal places. Here we go. Just pull this along. There we have it. The bear case, let's say it's 90%. It's probably more extreme than normal. The bull case will be higher than normal. We can save that for all of these. To work out what the bear growth rate will be, the bear case scenario growth rate would be, you take the base and you multiply it by the bear scenario, which is 90% of the 20% of the base. Lock this in because we're going to pull it along. And do the same with the bull. Lock it in. Pull it along. So equals offset. Cell that we're in, page 24. The switch, lock the switch in, comma, and 0. pull this along. We have it. To work out the potential revenues, you just go equals, and you take the previous year, multiply by 1 plus the growth rate. Just pull that along. There we have it. We're going to do the same now for the next one. So select it all. This is B11. Back. We need these figures here. So for 2021, they did 517.487, 792.571, 1.4, over 1.4 billion, 24. Where is it? Three zero seven three. Or let's work out what the multiplier is going to be. 2024 by 1. Okay, looks good. And this one is a very high growth rate. Let's say it goes to 30%. So G7. We just have to adjust everything, make sure it's corresponding with the correct cell. So make these bare and bull cases. Instead of it being a 10 like up here, it needs to be on 11. Same for this one. Change it 7. Cross. Yeah, looks good. Now we do the same for the last one. Will be 12, the revenue. Yeah. 484, 4, 5. Six. We need to do power divided by 6, 1, 5. Seven multiply 1. This one, let's put it towards it. It will trend towards 10%. I mean, do we really? I mean, this is a bit unrealistic. Yeah? Let's say, let's not use the average. We'll use the average of the last 2 years. Yeah, I think that's fine like that. Okay, we need to know the total now. I don't imagine going forward that it's going to be like 21, 22 again. I think it's significantly more established that it will. I mean, this was a very speculative period where people just and and then it crashed and people are like, oh no, it's all over. But no, I think it will be a lot steadier than it was even with the pullback now. I don't think it will be as extreme. Do let me know your thoughts in the comments. That subscribe button. I wonder, do any of you own Bitcoin? It's I mean, it's, for me, I'm very bullish on it. I've held it for a few years. And it's not something. I mean, the volatility. It's as you know, over time it will appreciate, but it's yeah, okay, that's good. We've got the growth rate there. Now we want to go on to the income. But it equal make sure you keep revenue. Make sure you put equals the revenue above, because if we update here, we then want to we then wanted to link to down here, and I'll show you for those if this is your first time watching one of my videos. You can see that every time we change the switch, it's updating it. Bullish scenario goes up 5 billion. Come back to base, it comes down to 20. I should have shown that a bit earlier. Sorry, it's I forgot. We go EBIT. So that we want the taxes. I want to know what they are as a. And in this, I mean, in this downturn, I will personally be looking to buy more Bitcoin. Let's just see where it settles first. Let the bouncing, the volatility sort of die down a bit, and then I will look to then I will look to add. Also, when I have the funds as well, it's still giving like, oh, it's great, it's down to 80, probably never get this chance again to buy. But what happened? Okay, so 2021, good operating income, and then it was negative in subsequent. But it is positive now, and Coinbase is profitable. So yeah, so let's start having copy the formatting now. Yeah, so EBIT. So your EBIT is your operating income, really. Here we go, 3076.57. And it was 2710.8, but negative. Once 1.62. Four 307. One one. The operating income is slightly less at this time, this time of the year than it was at the same point last year. For the revenue. So this can, I mean, it can be a very profitable company. These are great EBIT margins, 35, 25%. And it keep those because before it was the only game in town. Now you've got exchanges such as Gemini, Robinhood, eToro, Kraken. All of these are very well established exchanges, so they will eat into Coinbase's market share. So let's look for provision for income. Here, this is what we want. So when it's negative like this, it means Coinbase was paid instead of paying income tax. So go this 597, which is quite strange because in 2021 they were profitable. Why would they be paid? Probably something deferred and oh, what did they pay? In 2024 they paid rather than benefit. 3.578. Yeah, about a 16% increase. Looks like let's just multiply by that by multiplied by 1.3. There's that will get us to the end of the year. I mean, more accurate is we divide by 3, multiplied 4, 2. Ooh, okay. We can't really take an average from these because they're a bit warped. Okay. We're going to go on to the cash flow items. And these are depreciation and amortization, CapEx. Just leave a space because we need to work out percentage of revenue, then change in net working capital. The format. Okay, so the cash flow statement is here. Balance. this line. We need depreciation and amortization. Then we need one here, capitalized internal use software development costs, and probably this business combination too. And yeah, our change in net working capital is this net changes in operating assets. Great, so we can just copy that down rather than having to do the sum of the various different normally do. Okay, good. 6365 63.651 154.06 1392 x. We're going to say equals 22.073 plus 61.038 plus 63.202. What am I doing? No. Sorry, I'm not awake. Plus 70.911 equals 61.038 186 equals 3.202 plus 30.70. Change in net working capital is just the year 141.438 negative 103.326. Let's work out what these are as a percentage. Revenue. Very small amount. Go 2024 127 518 x. Didn't have any capex in okay, I think I've done something wrong. On the capex, the business combination is not a capex. That's just them investing in other companies. So let's take that off and just keep the first line. It's a very low capex company, Coinbase. Or yeah. No capex for no capex at all for 2024. Change in net working capital is minus 478.002. Let's have. We take divided by equals 117.312 multiplied by 134. Yeah. X. Again, there's been no capex for this year. Wow. Change in net working capital this line. Let's just leave it at what it says there. Negative 2510,846. Forecast the last 3 years. Pull that over. Revenue. Okay, when this doesn't look let's go with that. Let's see what it comes out with. Now we can build the actual DCF. Again, we bring revenue. Drag it across. EBIT. We're going to build out a switch for it so that we can simulate different scenarios with EBIT. Ooh, delicious. Copy the EBIT from what we did before, but only up to 2025. So yeah, I think that's we will put the EBIT heading towards about a 25%. Okay. But yeah, 25% G. Again, 90, 110 gives us a wider scope for more volatility. Work out the forecasted EBIT, we just take the revenue, multiply it by the margin, have it. Now, for the taxes, we want again just put equal to what we did last time. Sorry, up to 2025 equals to 5. average. Let's just do the average of the last two. EBIT multiplied by the rate. Pull it along. Yeah, and then have it. Now, we want to work out what our EBIT is, our earnings before interest, but after tax. Do this by taking the EBIT and simply subtracting tax. Yeah, earnings before interest, but after. So take your EBIT, subtract your tax. Hold it, put it along. Then we go A, and WC. Calculate unlevered free cash flow. To do this, we take our EBIT, we add back in depreciation and amortization because it's a non-cash expense. And we subtract the capex, subtract the change in net working capital. We just pull it along, and there we have it. For the next 5 years, this is what we're forecasting Coinbase to produce in free cash flow. Now, what we want to do is we want to calculate the present value of the unlevered free cash. And to do that, we need to build a WACC. So open up another sheet. Again, let's do our admin. Take your page layout, you take your grid lines off. A bit smaller and be larger, but there's no need to freeze it. Again, put coin in the top. So data, docs. There we go. Okay, so what is the WACC? The WACC is the weighted average cost of capital, and it equals your percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. Okay, we need a few components to be able to calculate this. Some of it we need to calculate to be able to calculate the cost of equity. We need to do another calculation there. Percentage of debt and percentage of equity also, but although they're a lot simpler. So the first thing we need is the market. Below that, percentage of equity, cost of equity. And in the cost of equity, we need the risk-free rate, the beta, and what was the other one? Equity risk premium. Then we need debt, percentage of debt, cost of debt, tax rate, the total here, then WACC. So market cap we know. And this equal, just go A1, open your parentheses, market cap, but divide it by 1 million so that it's formatted correctly for us. Okay, so Coinbase is about a $65 billion, that's how it's valued at the moment. It's about $65 billion. I think its highest valuation was north of 100. What can we do next? Okay, we know the risk-free rate because we're going to use the US 10-year Treasury. That is 4.07%, 4.068. Beta will calculate the equity risk premium, will calculate the debt. Let's come onto the balance sheet. Yeah. Long-term debt is about 6 billion. They have, okay, current portion. So 6 billion. So you say nearly 7 and a bit billion. Yeah, we want these two because they're interest-bearing debt. That's what we want to put down. Equals 1268.081 plus 5933.44. Okay. Yeah, we just go sum. Now we can get the percentage of debt. We take market cap divided by the total. Do the same here. Then the cost of debt and interest paid. Yeah, they do. So let's just do 62,820 divided by 3 multiplied by 4 to get an annual amount for that. 83.76 to 83.76 multiplied or divided by the total debt. They have about a 1 and a bit % cost of debt. The tax rate, I look for this. Okay, so we can see if you come down to page 26 on the 10Q for the 9 months ended 2025, about 20%. So let's use that. And okay, now the only things we have to do now is the cost of equity. We know what the risk-free rate is. We need to work out the beta and the equity risk-free rate because your cost of equity equals your risk-free rate plus your beta multiplied by the equity risk premium. So, I mean, Coinbase is, let's see how we would define it. This one, brokerage and I think it's these two. Financial services, non. Yeah, let's do that. I wonder if there's anything else we can put it as. Software maybe, but yeah, let's try that. See what comes of it. So to calculate the beta, we need the industry, we need the unlevered beta, we need revenue, EV to sales value proportion, then the weighted beta, and then that can give us what we need. So if we're going to say that so we'll go brokerage, investment bank, call it fintech, software, internet. I don't think we need this bit, software, system, and application. So 0.41, 0.27. Software and internet, 1.32. The revenues for this, so the brokerage is quite easy. Just put it equal to the transaction rate. Then the fintech, we can say it's the subscription and services. Yeah, I think we just do that, then equals, and we put this one as equal to transaction revenue, other revenue. We don't need software and internet. So the EV to sales for these companies are price to sales data, we want brokerage, service. Why does applicable? It doesn't show one for brokerage. So I think what we do is let's just put everything as fintech or financial services that are not banks. Let's do that. EV to sales is 19.3. The value, therefore, is your EV to sales multiplied by the EV to sales multiple multiplied by the revenue. This is obviously, therefore, the weighted beta is that 0.27. Sort of seems very, very low, but yeah, that's what we have to go with. Then let's work out the equity risk premium. To do this, we need to know where the revenues are coming from. Page 1450. We are. So we know revenues. We need equity risk premium, the weight, and then weighted ER. So US, international. Okay, so revenues for the US, we can just do to the 9 months ended 4156.062. The national 884 0.134. So the ERP, we will pull that up from the country data set. This. So for the US, the ERP on here is 4.61%. We use equity risk premium on here. On 4.6%. The rest of the world, what we'll do down here, this one, we will delete the North America row, and whatever comes up here will be our rest of the world 6.41%. Wait, so this. Now the weighted ERP, you just take the weight multiplied by the ERP. Then take a sum, 4.9%. So we can now calculate the cost of equity because we have these three components. So we take the risk-free rate plus the beta multiplied by the equity risk-free. Go. So to calculate the WACC, we have everything now. We go open brackets, take your percentage of equity multiplied by your cost of equity, close brackets, plus open brackets, your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. So we have it, a 4.95% WACC. That doesn't really look right. That seems far too low for a company like Coinbase. I mean, the equity risk premium is pretty much right because the majority of the revenues are coming from the US, which is less risky than, theoretically less risky than the rest of the world. It would be, I would have expected a WACC of about 10%, maybe 8, well, between 8 and 10. But especially that it's got a good mix of equity and debt. It's not like this is we've seen with other tech companies where it's 97, 98% equity and then a 2 or 3% debt. But anyway, look, we'll go with what it's come up with now, and we'll amend as we get more information later on. So let's come back. Take this, put it equal to your WACC. And for this, for a bear case scenario, I think add 1. Wait. We'll add 1% for the bear case scenario, so it increases the WACC significantly. Then for the bull case, we'll just do it a minus 0.5%, because we know it's not going to be. We know, I think the bear case is will be significantly worse than I guess the upside of the bull. You know what I mean? I know I'm not being. Terminal growth rate is 2. Well, minus. Now for here, we want to do another switch, but instead of using offset, we go equal to use. We just select all of these, but make sure to do them in the correct row. Okay, looks good. Now we can come back down to this, to the DCF, just put in another row up here and type 1 above where it says 2020. Go 1, 2, 3, 4, 5, and we want to calculate our present value of free cash flow next. We have everything we need. So we take the unlevered free cash flow and we divide it by 1 plus the WACC. We lock the WACC in and we close brackets and we do to the power of the year. All those over. So yeah, there we have the present value. So in the final year, we've discounted it. So it's in nominal terms, it's nearly 15 billion, but discounted to the present day value, the purchasing power of that is 11 and a half. The next thing we need is the terminal value. This is, you take your final year, multiply by 1 plus your terminal growth value, divided by your WACC minus your terminal growth value. Well, 625 billion. Then we want to know what the present value of the terminal value is. We do exactly the same. We go divided by 1, the WACC, to the power. Then we want the enterprise value. Go just sum up. We sum up the present value of the terminal value and the present value of the unlevered free cash. So an enterprise value of nearly 530 billion. We want to add back in cash, and I'm going to add in the Bitcoin as well, or whatever. Actually, no, we'll just do it as what it says on the balance sheet, and we'll minus the debt to get our equity value. We want to know the diluted shares outstanding, and this will give us our implied share price. Back onto the balance sheet, which here we are. So let's say that cash and cash equivalents and then USDC. USDC is the stable coin for the dollar. So we'll put that in cash and cash equivalents. I think their Bitcoin is in this cash equivalent thing, so we don't need to do anything with that. One thing we might want to do is, if this was September the 30th, 2025, meaning at that time Bitcoin was about 110, I think it was about 110,000. Now it's trading at 83, 84. So in reality, this cash is now, let's say, what would it be? Maybe 7 billion instead of 8.5 billion. So that's something that we have to keep in mind. But obviously, when Coinbase releases its annual report next year, we'll see what the balance sheet shows there, and we'll be able to have the be able to understand that better. But for now, we'll just use what's on the balance sheet because it's not separating down the Bitcoin portion of the cash and cash equivalent. but we'll go 8676.275 plus 3696.441. We won't use restricted because it would, I imagine that means even though it's in the current assets, it's, I mean, actually, we can put that in as well. Let's do that, 78.867. Then the debt is, we know the debt because we calculated it for the WACC. Go. Equity value is you take your enterprise value plus your cash minus your debt is your equity value. Then we want to know the diluted shares outstanding. This is on the income statement. We want the figure down here. So we'll go 283,165. I think the worrying thing is look how different it is from the basic. It means they're doing a lot of stock-based compensation. And we can look at that on the cash flow. Yeah, that can be a bit worrying. And I think they do a lot of buybacks. I mean, I think their stock-based compensation is valued about $1 billion a year. Their buybacks are about $1 billion, so they're canceling each other out. Okay, so 283,165. Okay, so the implied share price, wow, 1899. So there's a hell of a lot of upside on this. Okay, so I mean, if we were to go, let's look at this on the bearish scenario, 982. And personally, I don't think that is that unreasonable. I mean, I'm very bullish on Bitcoin, so I think I'm a bit biased here, but I think Bitcoin will, sorry, Coinbase, as I guess the most reputable name in the business, even with market share going to the likes of Robinhood, Gemini, etc. I think it is still it will be the market leader. Its institutional part of the business will grow at a very big magnitude. And I know Bitcoin's coming down now, and but it's happened. We've had all this before. Oh, this is the end, and then it comes back and it goes on to bigger and better. So yeah, so even if there'll be maybe it could be a good amount of time where Bitcoin is in sort of crypto winter, but over the long term, it will keep growing, and as well as we're seeing all of the investment banks like JP Morgan building out their crypto arms. They'll use Coinbase forecast as this. So for me, this significant upside is not the problem. Is not unrealistic. I do think the WACC needs to be higher, but let's say hypothetically we put in an 8% WACC. There's still a good amount of upside there. One thing I think we'd probably need to do is price the cash equivalent to whatever Bitcoin is at the moment. Are we being too optimistic on anything? Revenue, I think. And I think Coinbase can grow at these. Maybe we're even being a bit conservative on these revenue forecasts as well. So yeah, I think the big thing here is capex will have to start. They'll have to start, yeah, growing that, even though it is a capex like business. The change in net working capital will probably be less than this as well. Maybe that trends towards maybe 5-6% of revenue. But yeah, put your own numbers in and let me know what you think. And we'll see you on the next one. Again, please hit subscribe. Apologies for not releasing a video in a while. I was on vacation last, so I didn't really have time. But hopefully, over the next few days, I'll be able to get some more out. I'm thinking of doing Nvidia tomorrow. So yeah, stay tuned for that one. Anyway, thanks guys. Have a good rest of the weekend. Bye.